Man, listen, the banks want you to be in debt for at least 30 plus years. But what if I told you you can actually cut that time in half without doubling your payments, without sacrificing your current lifestyle? You see, too many families there used to making those payments on time, right, but not making any actual progress. Today, I'm breaking down how you guys should pay off your mortgage faster using the strategies that the wealthy use, right? And that's what we teach here at Simmons Legacy Investing. So make sure that you can get out of that survival mode and get into that thrive mode, right? But before we dive in, hit that subscribe button if you're serious about building faith, family, and financial freedom, because that's what we're all about. That's what we stand for. We'll make sure that you guys get to the top and that you can always win. Number one, make sure you guys stop thinking like a borrower. Okay, most people think they just do what they're taught. They make the payments and you wait the 30 years. But see, that's that debt mindset, right? Legacy builders, we think differently, right? They ask how you can use the system and buy back your time instead of using all of it just to get this mortgage paid off, okay? Before we dive into those strategies, I want to first bring up, what a mortgage is. You know what I'm saying? A lot of people don't realize you can actually qualify for a mortgage without a significant amount of income. Okay, a lot of people think I need to make $5,000, $6,000, $10,000 a month qualify for a mortgage, and that is actually false, guys. You don't have to make that much money. Believe it or not, you do need to be at your job for at least a year. They that's what a lot of mortgage lenders want, preferably 2 or 3 years and up. But you really don't have to make that much income. Okay, so really so this is how it's calculated. Okay, I'm going to kind of break it down in some layman terms for you, right? So think about how much you make in general with your income. Okay, with your job, if you're making most people making maybe my little sister work at the airport, she's making $2,000 a month, right? Which isn't a significant amount of money, okay? But look at it this way: $2,000 a month, okay? So the banks go off of your the mortgage go off of your debt to income ratio, okay? So they want to see how much this mortgage is going to cost, and then how much income you got to cover that, okay? They want you to stay below that 50% margin. So if she's making $2,000 a month, then her mortgage need to be below $1,000, okay? And believe it or not, well, even with some of these high interest rates, you can still a mortgage paying $1,000 can go you a long way. Okay, you can actually buy. Let's put it this way: if you get a amortization calculator, okay, it will actually show you how much the monthly payment will be. So, for example, one of my rental properties, right? The mortgage I have on that property, it's the loan on it is actually a $80,000 loan. Okay, for the 30-year time frame, right? But the monthly payment on it is nothing but $400. Okay, so if let's say my sister was buying a house from me, I sold it to her for $80,000, right? Now the monthly payment is $400, but she made $2,000 a month. She could actually get a mortgage on that house because that $400 a month is less than that 50% ratio, which I told you earlier is $1,000. Does that make sense? So basically, you as someone who want to first see if you qualify for a mortgage, you don't need that much money like you think. You really don't. Yeah, you got to come up with a down payment, typically 3.5% of the down payment. But if it's on a $100,000 house, so you know, if you do the amortization calculator, depending on the taxes and insurance, you could get that for around $500-$600 a month. All right, $500-$600 a month. So that is within my sister's threshold of $1,000 or less. Okay, so now even with the taxes and insurance on it, you will put that on there. Typically, insurance is like $2,000 for a year. Taxes could be anywhere from, that particular rental property taxes is only $200, but it can be $1,200 or so like that. But you divide that taxes and insurance by the year, okay, and add that monthly amount to what that cost is. So if the mortgage payment itself for the house is $500, and then the insurance for is $100 a month, so 500 plus that 100 makes $600. Okay, then let's just say for kicks and giggle, the taxes is $1,000, whatever. So that's like $108. You put that to it as well. Okay, so that comes up to about $700, which is all less than that 1,000 ratio that she needs to have. Okay, so that $100,000 for a house, and her monthly payment is $500, and then the taxes and insurance break up another $2. She's sitting at $7. She still got $300 window left over. So as long as she don't got a car payment or any of these installment loans that will boost what you have to pay, guaranteed over that $1,000 mark, then you can qualify for a mortgage, guys. So it's really not that difficult to get qualified for a mortgage, contrary to most people believe. Okay, so if you made $2,000 or actually more than that, you can actually go shopping. Okay, you could go shopping. All right. Here's a simple investing. We're about helping you get your credit right. If your credit isn't at least 580, you can qualify for a mortgage for 580, 620, what they want you to be at, but you get qualified for a 580, right? And if you don't have that, we'll definitely get you right for that. It don't take that long to build, to be honest. And it may take you a while to get stuff clean, but it don't take long to build. You get that done in a month if your credit, if you got a blank canvas, we can get you to the 700s within a month and a half, within 6 weeks. For sure. We've done it so many times already. Okay. But just so you know, okay, you can qualify for a mortgage with just that small amount of income, right? Now your purchase price wouldn't be that high. And this example is only at 100,000, but you can find some condos for 100,000 no matter where you at, right? Whether it's in Atlanta or in Jacksonville, whatever. We're out here in Jacksonville, but my sister out in Atlanta. There's some condos out there for 50 grand, 80 grand. And she could buy that if she chose to do it. Now, I wouldn't advise it as far as investment side of things, but you could do it. Okay. I mean, I'm big. For what we do in serious investing, we're big on helping you create passive income first, right? And then you use that passive income to pay for any place that you're staying at. That's the way that we teach you as an investor. But when it comes to you actually just getting a mortgage, you can do it that way. All right. So we broke that down. So now you kind of got the idea of what it takes to get a mortgage. Okay. You don't have to have a whole lot of money. You just got to make sure your debt to income ratio is below that 50% margin, and that whatever house you're going to buy, get a amortization calculator and put in the price of that house into that amortization calculator with the interest rate that's going to be on it, which right now is looking like 7%, right? 8% on the high end, right? You get what that number is, and as long as that is below your 50%, you're good to go. Now, if you have other debt outside of that, then that's going to push you over the edge, and then you won't qualify. But all you got to do is lower your buying power, lower that amount from 150 to 120 or to 100,000. You get what I'm saying? So that's how that will work. Okay. Now, as far as after you got your mortgage, the next step you want to do is you want to do it smartly, right? You don't want to hold it out for the next 30 years. Like, come on, man, right? You want to knock that thing down some. So, first strategy we'd like you to use is your biweekly payments. Okay, say you paying, like, for example, with my sister, if she bought that 100,000 house, that's with the interest and insurance to 700. Let's say instead of her paying that 700 once a month, we'll say no, pay that 350 on the first, and then pay another 350 on the 15th. What that will actually cut down her 30-year mortgage by at least 4 to 6 years. And reason why is because the interest is calculated on a daily. So the power that you front load on the front end a lot faster will actually lock down the amount of years that you actually have the loan for, and will in turn lower the interest that you pay on the loan. Okay, so paying the balance twice a month will actually shorten your loan term and actually save you money. So that's the strategy that we use as well. So say you're making 12 payments for the year, make 26 half payments. Okay, excuse me, and that will cut down your terms of how long you gotta keep your loan. The next strategy, we call it the velocity banking method, and basically it's a credit method, credit equity method. Okay, now with this method, you got to have equity in the house that you're buying. So if you bought the house for 80,000, it need to be worth 150. You gotta be worth more than what you bought it for, or you had it for a while, so you paid it down and it has some equity now. Okay, but you can take out a HELOC, and then when you take out a HELOC, home equity line of credit, you can actually use that to pay your bills, pay your payment, pay everything that you have along with your mortgage payment as well, and then use your current income to just pay that down. Because when it's a HELOC, it actually calculates interest on a daily basis. Okay, so every single day that you're paying it down, your interest long term is actually getting eaten up. Okay, so you want to look into that. It takes training, takes discipline, right, and it takes a strategy for be paid down with your income. But using that strategy, you can knock your payment down by at least 6 or 7 years. Okay, and that's what you really want, right? That long-term interest saving. Okay, strategy number 3, right? If you make an extra principal payment for the year, okay. So example, for my sister, her monthly payment is $700. If she make another $700 for the payment divided by 12, so you take that $700 monthly payment. So let's say her monthly payment is $1,000. Make it easy. It's $1,000, right? That's her monthly payment, $1,000. Well, you divide that $1,000 by 12. Okay, whatever number that is, right? I think it's like 80 something. I don't know right now. But anyway, She make that 80 something payment. You make $1,000 payment, the 2 times a month. Like the first and 15, she make the the 500 to get to 1,000. Then you pay another 80 bucks or whatever that number is divided by 12. You put that in there as well at the end. That alone as well would knock your score down, knock your turn that you have the house for at least another 5 to 7 years. Okay, so these are all ways for you to strategize to knock your term down, so you don't have to have the mortgage rate. You're not changing your lifestyle pretty much at all, right? Like the monthly payment of $1,000, you divide it by 12, whatever that number is. That's strictly minimum. You could DoorDash, you know what I'm saying, make that in 3 hours. You're not really changing your lifestyle much at all. Very, very minimum. And it's gonna knock down your payment, your term for your house or your mortgage for at least 5 7 years. So that is a powerful strategy to use, guys. You can use your tax returns or your business income or any type of side hustle you got to make that payment. Okay. Strategy number 4 is you can refi with a purpose. Okay. So don't just refi to start yourself over just to get a lower payment term. No, you don't want to do that. First, you want to calculate how much interest you paid. Okay, that's number 1. Then you want to say, all right, well, how far did this rate drop? Right? If you rates was at like high, sky high, well, not sky high, but they're higher than they've been in the last few years. They're like 7% right now. And then let's say the next few months it dropped to 3%. Well, you want to refi for that new interest rate. Okay, and you not only do want to refi for the new interest rate because it dropped down a lot, you also want to shorten your terms. They go from 30, go to 15, go to 25, right? When you do that, that's going to lower the amount of time that you have. And it's actually strategy because now your payments are pretty much about the same that you were before you refinance, but your term is significantly lower. Right? So you save more money on the interest that way as well. So hope it's been some value to you guys. Once again, if you like the content we're putting out, definitely feel free to like and subscribe and follow us. And DM me if you want to tap in and learn more strategies like this. And we'll talk to you soon. Peace.